So, ladies and gentlemen, welcome. We would wait for some time for the participant to join, and then we'll start the call. Allow us a few moments, and please bear with us. Yeah, so I think we should start the call. So good evening, ladies and gentlemen. I welcome you to the ASK's market outlook and update call, quarterly update call. Right, we have Mr. Chetan Thacker today, who would take us through our ASK's emerging opportunities portfolio, and the flow of the presentation would be wherein Chetan would take us to the market outlook, the portfolio construct, and it would followed by the question answers at the end of the thing. So I would request you to post your questions in the question box, and we would curate, and I would take you through as a moderator. I would take you through take all your questions, and we will take an answers from Chetan. To introduce Chetan, Chetan is a senior portfolio manager with us from 2015. He has over 15 years of an experience. He has worked with McKinsey and company, and then he is with us from 2015, as I said. Chetan basically expertise on the sectors like agriculture, metal and mining, and mid caps. So, Chetan, I would request a floor to you, and please take us through the presentation. Over to you.
Sure. Thank you so much, Manoj. Thank you, ladies and gentlemen. Thanks a lot for joining us for this quarterly update call. As Manoj highlighted, I'll just take you first through the market update, what we've done to the portfolio in this quarter, how it has performed, and then we'll open the floor for questions and answers. So just to begin, I think as we look at the calendar year 24 so far, what has played out is that yes, GDP has held out better in terms of growth. We've actually seen an upward revision in GDP for the country by IMF. We've also seen the RBI scale back as far as the inflation projection is concerned. One point that we've been highlighting here for quite some time is that food inflation is a worry, and that has turned out to be a bit more sticky. The expectation is that as monsoons have covered ground, we should start to see some easing of inflationary pressures as we head into the second half of the calendar year, particularly once the Kharif crop hits the market. And that in turn should provide some degree of elbow room as far as the monetary policy is concerned. On the macro front, I think a good takeaway from the budget has been that despite the announcements on spending more towards the social sector, spending more for job creation, the government has stuck to its fiscal deficit glide path, and there is a 20 pip downward revision as far as fiscal deficit is concerned. So this has been one of the key takeaways from the budget, that while being expansionary, they have ensured that they remain on the fiscal deficit glide path, which remains very crucial. Similarly, on current account deficit, I think it is hovering around this range of close to 1%, 0.5 to 1%, and it remains there. So that again is a positive sign as both the twin deficits remain largely under control. On the election outcome, I think, yes, the outcome was a little underwhelming as compared to the expectation. But what we've seen in the budget is there is a continuity on the policy, and that is heartening for us to note that the policy continuity still continues with the new government in place right now. On the monsoons front, I think we were suffering with some degree of El Nino impact as it was getting out of the system. There is an expectation of that turning into La Nina. That means that you will see better monsoons. So far, we've covered up the deficit of the June month, particularly as far as monsoons were concerned. While spatial distribution still is a concern, but the spatial distribution is lower on the eastern part of the country, which remains well irrigated. So to that extent, I think pockets which need more rainfall or which are more rainfall dependent have seen fairly good uptake as far as monsoon is concerned. Why is monsoon still very much important for us? Primarily because we still have a large rural population, 65%, a large dependence on agri as far as the workforce is concerned. While as a share of GDP, it is at 15%, but from people employed, it still is close to 45% of the labor force that remains employed. on the agriculture side. We've actually seen 2 poor years of monsoon on the trot, which has meant that there is a play out of that happening on the food inflation front, which we were highlighting is a worry. And the way the monsoons have picked up, we remain positive and will monitor in the crucial months, which are September and probably last bit of August. Given that it has started a month late, the expectation is that it might continue a bit more into October. And we've seen this gradual shift that has happened in the monsoon pattern, where the seasons have typically shifted by 15 to 20 days. So the expectation is that it's picked up a month late, it might carry on for some more time into October. Coming to the high frequency data continues to remain positive. We've seen fairly good degree of pent-up demand play out on the rural side, particularly by way of growth on two-wheelers, which has been a pain point and also bellwether as far as the rural health and economy is concerned. We've actually seen a fair degree of uptake as far as two-wheeler volumes are concerned. This had been lagging for the last 2 years and probably was the last to pick up post-COVID. So we are now starting to see robust growth as far as two-wheelers are concerned. Similarly, personal loan growth, petrol consumption, the PV growth all point towards the momentum continuing. Despite the fact that we were in an election mode, there was a high precedent heat wave that were playing out in this period. Despite these adverse events and factors, we've actually seen the economy hold on quite well as far as the first quarter is concerned. The expectation from here on is, given that monsoon is typically a lean period, we will see that seasonal impact play out. People are gearing up for the second half, which is the festive season. This time we have festive, which is a tad bit earlier compared to last year. So we should start to see a positivity of festive demand starting to play out somewhere in the middle of September. So as opposed to last year, where the festive demand started to pick up only in October, there could be a 15-day preponement given how the festive period is lined up for this particular calendar year. Coming to the outlook, I think from a global front, we've actually seen most of the large developed economies manage to go through the period of high inflation with relatively stable GDP growth. And we've actually not seen the kind of recessionary fears that were there a year and a half back play out. We've actually seen the growth remain a bit more resilient. In terms of events to watch out from a global perspective, US election will be a crucial event that is there to be seen very closely, because that will determine to some degree on how the policy plays out going forward, depending on which party comes to power in November, which is scheduled towards the end of the calendar year. From an earnings perspective, I think this year clearly, as we've been highlighting, is a year where volume growth needs to drive operating profit growth, and that will remain a key focal area. Given how things have played out, our anticipation and expectation is things start to pick up, particularly from a volume perspective, towards the second half of this fiscal year. We are monitoring the data that is coming up from ground up. Our sense is that September second half will probably start to show the degree of momentum that is anticipated, and that will be a period that we'll monitor very closely. As you recollect, I think last year the issue was a pre-festive demand held out well, but given how the monsoons had played out, particularly in the Kharif period, we actually saw volume growth suffer and there was no follow-through demand after the festive season. The way monsoons are playing out this year, the expectation is that you will continue to gain momentum as we move ahead. Second bit, from a global perspective, I think last year was a period where exports were also under pressure. What we are witnessing is that we've seen a fair degree of the higher competitive intensity from China already playing out. We are probably approaching towards the end of the global destocking cycle. I think higher freight costs to a certain degree are adding to volume growth because again, supply chain and lead times are expanding, which means that the restocking period will probably start somewhere towards the second half of the calendar year. The expectation, and based on what we are hearing from managements very clearly, is that volumes will be the first driver that will start to inch up. Pricing still remains a concern given the high degree of competitive intensity from China, where we are actually seeing pricing pressure continuing to remain in the system. Coming to the focus area as far as our portfolio is concerned, as you would have witnessed over a period of last 12 to 15 months, we've made some degree of pivot. We've actually pivoted the portfolio towards sectors which we believe will do well from a more medium to long-term perspective. Clearly, two things stand out. One is manufacturing and infra, where we've increased weight over a period of time over the course of the last 12 months. There are various underlying factors which are driving this demand, be it industrial capex, which started with the government. My expectation is, given where capacity utilizations are at this point of time, there will be a follow-through demand that happens from the private side, and you start to see improvement as far as capex is concerned from the private side as well. This budget, while it has not increased significant allocations, but they've maintained the allocation as far as defense, railway, and capex is concerned. Capex allocation remains at 11.5 trillion, which is somewhere similar to what the interim budget had. They've balanced it well, despite moving some degree of allocations towards job creation and social spending, which probably was an outcome of how the election results played out. Moving to the power sector, the expectation is, given how power demand is playing out, there is a higher need of capacity build up there, and our sense is companies in that value chain will continue to benefit as we move along. While we are now starting to see clear-cut positive benefits of the PLI schemes, as most of the capexes are starting to get commissioned or have got commissioned over the course of the last year and a half, and you start to see a follow-through play out in terms of both revenue and volume growth that happens because of PLI. So our sense is you will see this benefit continuing, not only as far as import substitution is concerned, but also as India emerges into a big export hub and gradually gains momentum as far as India's share in global exports is concerned. The second big of higher exposure is on the consumer side. We believe discretionary, which has been under pressure for the last year and a half, will start to see an uptick as far as both volume growth coupled with margin improvement is concerned. We've seen fair degree of pain as far as SSG is concerned for this particular sector. Our sense is as demand picks up, particularly near the festive period, and the expectation is there will be a follow-through demand that happens, and consumer discretionary is a pocket which should continue to benefit from a more medium to long-term perspective. In terms of risk, clearly from a global perspective, geopolitical situations remain a big risk, and we are seeing escalations there. We've not seen any pullback as far as geopolitical risks are concerned. A big play through of that, as far as we are concerned, happens particularly on the energy price and their impact on the energy price. So we are monitoring that closely. From a more domestic perspective, the risk still remains of monsoon, while we've seen a good uptick as far as the month of July and early part of August was concerned. There has been a fair degree of dry spell in the second half of August. This typically happens in July, but I guess because the way seasons are moving, our sense is you should start to see an uptick again in rainfall activity somewhere during the period of September. So we are still monitoring monsoons very closely. This is a crucial aspect, primarily because of the fact that if we again see monsoons being below normal or inadequate spatial distribution playing out, the rural pocket will then need direct support as far as the central government is concerned, which will mean that some degree of allocation will then move there to support the rural economy. So we are continuing to monitor this closely, because this will determine the extent of volume recovery which we can expect, particularly in the festive period and the post-festive period. Coming to global growth, while yes, we've probably seen a lesser impact of inflation as far as global growth is concerned, but we are seeing some signs of deceleration, particularly in the large developed parts of the world. So we are monitoring that also closely, because that to a certain extent will determine how our export growth picks up. And that is expected to be a tailwind as we move into second half of 25 and 26, because that has been a big headwind as far as FY24 was concerned. Coming to valuations, broadly at an index level, I think we are closer to 10-year average. The expectation is earning momentum continues to remain higher, and that is backed by expectation of volumes picking up. In terms of summary of earnings for Q1 FY25 that just got concluded, I'll take them sector by sector. While overall, I think the earnings have been in line or marginally better despite the election and the heat wave. So we've actually seen earnings get delivered, which were a tad bit better than what was anticipated as far as even our portfolios and even the index broadly is concerned. Coming to sectors, clearly auto ancillary stood out as far as the performance is concerned, driven by volume growth on both two-wheelers and the passenger vehicle. while CV and tractor volumes were muted. So to that extent, companies that were exposed to that segment saw muted volume growth. While the entire space actually witnessed a fair degree of margin traction that continued, primarily driven by the benign commodity prices. So that benefit continued, which meant that you had a combination of both volumes driving operating leverage plus operating leverage being driven by gross margin expansion. Coming to banking and financials, that is a pocket, particularly the lending side and the banks in particular, where we were expecting the pressure on NIMs to continue. So that has continued in this quarter. There has been some degree of uptick as far as credit cost is concerned. We were at a dismal credit cost level last year. So our expectation was you will start to see normalization in credit cost, and that has started to happen. While companies that were exposed to capital markets, they've continued to deliver robust performance driven by the capital market activity that we witnessed in the first quarter. On consumption, I think we are seeing early signs of bottoming out. Q1 was again a quarter where we saw SSG was negative. Having said that, incrementally, we don't expect things to get worse from here, and we expect things to start to improve gradually as we approach the festive season. When the volumes improve, you'll probably see a better impact of that playing out on the profit front because you will see operating leverage play out on the positive side as far as consumption is concerned. On chemicals and pharma intermediary in particular, like I was highlighting, while the destocking cycle is coming to an end, the expectation is volumes start to recover starting H2 of this particular fiscal year. On the pricing front, what we are hearing is there is still a fair degree of competitive intensity from China. So that means price recovery might still be more back-ended, while we will start to see volume recovery happen first. To begin with, the expectation is this starts to happen in Q3 and Q4. Coming to the engineering, industrial, and cap goods space, earnings here have been a mixed bag, primarily driven by how execution has played out. So sectors or pockets where execution was impacted, particularly because of election or the heat wave. There we've seen some degree of execution mismatch, while order book continues to remain healthy and robust. So the expectation is even in those pockets, you will start to see earnings recovery happen as we move into particularly Q3 and Q4 because Q2 still remains a monsoon period. Well, there have been select pockets which continue to do well, which are not exposed to either the heat wave factor or the ramifications of elections on on-ground activity. So those pockets have continued to do well. On OMCs, refining margins were impacted in this quarter, given how global refining margins played out. As we look ahead, the expectation is that gross margin GRMs will start to improve the gross refining margins from Q2, while marketing margins were normalized in Q1, and they helped partially offset the negative impact of GRMs. On pharma and healthcare, so pharma in particular, we actually witnessed domestic volume growth remain stable, while benign input prices supported operating profit growth in the first quarter. On the hospitals and entire healthcare space, we've actually witnessed steady patient volumes, while increased to RPOP was limited, which limited the impact on revenue growth, which has supported margin improvement. So in a nutshell, I think the way earnings have played out, they've played out either in line or tad bit better than what we were expecting, because we were expecting a fair degree of higher pressure given the elections and the heat wave. Coming to the portfolio performance in the first quarter, we've actually seen 26% operating profit growth for our portfolio as a whole, and PAT growth has been 21%. As we look ahead, the expectation is with volume growth continuing, we should actually see an uptick as far as operating profit growth is concerned. So for FY25, X of OMCs, we penciled in a 31% operating profit growth, which translates to 24% PAT growth, and that accelerates as we move ahead into FY26 to a more 27% PAT growth, which is higher than the benchmark growth. As you are aware, we've taken fair degree of actions, and that continues even in this period. So what we've done here is we've actually summarized what we've done CYTD till now in terms of portfolio actions. One thing which clearly stands out from the entry and exit is that we've increased allocations to industrial manufacturing. We've increased allocation to consumer discretionary, while at the same time there have been certain names where we've actually built positions and we've seen fair degree of uptick happen on stock price. So we've booked profits and moved out of those names. So something like a Honeywell Automation would stand out there, where we've essentially bought and sold in the same period as well. Also, given what we have been mentioning for some time, that there is an uptick in agility at our end, companies where we've actually seen pressure on earnings, we've been swift to take corrective actions. So something like a Cyient, where we've seen now 2 quarters of disappointment, we've actually exited out of that and built a position in KPIT, where we believe earnings momentum will continue from a more medium to long term perspective, given how ER&D spends are expected to play out in the more near term, because the auto spend still continue and that remains a big driver. We've also built some positions in niche sectors, particularly recyclers, something like a Gravita, where we believe there is a strong policy tailwind. We are probably today in the first phase of that policy transition, where there is an expectation of higher recycling and that obligation has been put on companies by the government. But the second phase is all the more interesting because that phase essentially pushes companies to not only recycle but to reuse as well, and that increases the role of recyclers in the country and pushes circular economy, which should benefit companies like Gravita as we move along from a more medium to long term perspective. Coming to how the portfolio is positioned, so we still continue to be predominantly positioned in the mid cap and small cap space, which is where this portfolio focuses on. While there is a large cap exposure, the large cap exposure, as we've been highlighting, is in businesses where we believe that scale is needed to compete in those sectors, and that is particularly the pocket where we have some degree of large cap exposure. Given what has played out in terms of performance, while we started to see some degree of uptick in performance, our expectation is that since the earnings growth is anticipated to be more back-ended, you will actually see stock performance also follow through as far as the earnings growth are concerned. So they should be in line with how the earnings play out. So very clearly, we are more focused on the second half as far as the earnings are concerned. And our sense is we will start to close in on the gap gradually. And that is the expectation given the number of changes that we've done and how we've transitioned this portfolio. So as earnings start to get delivered for this transition portfolio, the expectation is that catch-up continues to gain momentum. Coming to the psychography of the portfolio, so two things stand out here from this table in particular. One is clearly the EPS growth profile of the portfolio. So we expect earnings to grow by 24 and 27% ex of OMCs in 25 and 26. The ROC remains significantly better than the index at close to 36%, with growth remaining higher. So the expectation is that as this earnings growth gets delivered, you start to see a higher delivery as far as return is concerned compared to the benchmark, and that will open up space to create alpha. Coming to the portfolio PE, this is how the picture looks like. So as we've been highlighting for some time, there has been a compression as far as our PEs are concerned. There are two factors to it. One clearly is that earnings growth has played out in the last 3 years, but we've not got commensurate returns. So that means that relatively the valuations have compressed and it's become relatively more attractive. The second bit is obviously to do with how cost of capital has behaved, and that is something that we believe that as we enter the second half, given the elbow room that the RBI might get, particularly based on how we see inflation play out in the domestic parlance, and also how the Fed is expected to behave in the next 1 year, there will be an elbow room that opens up. Given the central government is very much focused on the fiscal glide part, so that clearly means that provides an additional elbow room to RBI to go ahead and cut rates, because food inflation today is one of the most sticky aspects, and that is where there is a dilemma of when to start the rate reduction cycle. So that is a key monitorable as far as the near term is concerned. With that, I just pause here and will be happy to take questions. Over to you, Manoj.
Yeah, thank you so much, Chetan, for the detailed insight on the market outlook as well as the portfolio. I would request participants to post their questions in the questions, and I will curate it for you. Yeah, and meanwhile, I have quite a few questions also, which has been passed on by the DRMs, the IFAs, right? So the first question is that I had a privilege to be on the floors, be on the client's place also along with you, right? Last 2 years there is a relative drag in the portfolio, and we have been highlighting the quality and the growth of the portfolio and how we are placed in terms of the earning profile and other things. Here, the broader question comes is, one, there is two set of years wherein we have seen large mid cap and small cap rally, which we have relatively missed. How is our portfolio placed to cover up? And what are, so we can see it very well covered by you. We have significantly made changes, but how, and which is also highlighting in the last 2 quarters performance. But the questions are coming on the broader performance, that how are we going to cover up in the going forward? Over to you.
Yeah. So I think, like we've been highlighting for some time, there were a couple of changes that we needed to do at our end. One clearly was the positioning of the portfolio, which we worked on over the last 12 months to position the portfolio where we believe earnings tailwind will be higher for a longer period of time. So that is one aspect that we've undertaken in the last 12-month period, 12 to 15-month period. The second bit was more to do with the fact that while remaining within our investment philosophy framework, how can we add to performance by becoming that bit more agile? And as I've been highlighting for some time, what we've done here clearly is that while erstwhile we would look at companies which can deliver 20% earnings growth from a more longer term perspective, we've said that if we find companies which can deliver a higher earnings growth in the near term, while the longer term earnings growth may be 17, 18%, but valuations don't adequately capture that, we will probably participate in those opportunities and take advantage of that and book profits and move out when we believe they are closer to fair value. So I think some of the names where we've done that is probably something like a Sudarshan Chemical, Honeywell, and Alchem, where we've actually entered into businesses where we believe that while long-term earning growth may not be 20%, but near-term earning growth is higher, and that is not adequately captured in the stock price, so we participated there. So the idea there clearly is, with the changes that we made to the portfolio and what we are making to the portfolio in terms of the higher agility that we've infused, the expectation is, can we catch up 200 to 50 basis point over and above the benchmark, while remaining very consistent with our broader investment philosophy and not diluting on the philosophy of high quality and high growth. So we continue to remain focused there. And within that framework, the idea is to optimize. I think one key aspect which has impacted our performance is cost of capital in the last 2.5 to 3 years. So the expectation is, whenever you'll see a reversal, you will see some degree of re-rating that will happen. When we look at the portfolios, we don't capture that benefit in terms of how that will play out in catching up the performance compared to the benchmark. So we are very organically looking at it to say that, can we capture 200 to 50 basis point organically by the changes that we are making to the portfolio. As we look ahead, like you rightly pointed out, the ROC profile is superior to the benchmark. The earning profile is superior to the benchmark. We've seen fair degree of time correction. So the sense is that as earnings growth plays out, particularly in the second half, you will start to see that catch up happen. Typically, markets start to price these things in a quarter or 2 quarters in advance. So the expectation is, once there is a fair degree of visibility on how the monsoon has played out towards the middle or end of September, and that is when the primary stocking happens for festivities, and you will start to see information follow through as far as festive demand is concerned. I think there will be an increased confidence on how things are playing out on the volume front. So while yes, that remains a big opportunity because we build positions in sectors and pockets which have suffered, and our sense is the volume growth comes through, you will see the vicious cycle start there, and that will have a strong tailwind for the economy as a whole. The second bit is clearly from the exports front. While there has been competitive intensity which has remained higher, the expectation is the volume growth starts to catch up, and what was headwind last year starts to turn into a tailwind. So you will see exports also start to deliver, which to a certain extent were dragging performance, not only for us, but in general at an economy level as well. We've seen exports remain a drag as far as the last fiscal is concerned. So as we look ahead, our sense is there will be more visibility on how volume growth is expected to play out. We have already witnessed the pain of time correction. Earnings are superior to the index. The quality or ROC is superior to the index. So you start to see outperformance and possibility of alpha opening up. On top of that, the alpha should get added by the changes that we are making to the portfolio.
Thank you, Chetan. Meanwhile, we can see that the flows are changing chasing small and mid cap, and we can see that the regulators are also highlighting that there is kind of an overheating of the small and mid cap, and our portfolio predominantly is based in mid cap space. So how are we taking care of that concerns like?
So we've always remained very bottom up, very focused on the quality of businesses that we are buying. And I think the only way to pair out volatility from a more longer term perspective is quality of business. So that is what will help you tide through this period of volatility whenever it happens. As we look ahead, our expectation is even within the mid cap and small cap pocket, companies which will end up delivering on the high expectations that are built in as far as their valuations are concerned will continue to do well. Companies where you will see earnings not follow through in line with what is expected will probably see the pain that plays out. So it will become more stock specific. So far, it was a period where you were actually seeing the entire pack do well from a market cap perspective. We remain very much focused bottoms up even as we build positions in mid caps and small caps, continuing to stick to businesses where we believe the quality is right, earnings trajectories is expected to accelerate, and that is where we build positions. So I think the only counter volatility is quality.
Yeah, I think we have taken a broader view. Maybe we can take few stock specific questions as well. Maybe to start with, we can take that there are certain winners also in last few quarters, right? On the battery side, even on the recent mining side, there are quite a few good calls which were taken, and that traction of the transactions in the portfolio has relatively helped. My question is that there are some stocks which we have selected in the portfolio have been a drag, like Navin Fluorine. If you could please take us through the thoughts around that.
So there have been two or three stocks which have not performed in line with what we were expecting. Naveen Fluorine is one of them. Serima is the second one where we've actually seen things not play out as anticipated. So as far as Naveen is concerned, well, structurally we remain very positive on the chemical space. We believe that's a big opportunity for India. India's gained market share there. We are actually seeing a fair degree of move away on the supply chain side, particularly away from China to alternate destinations, and where India is positioned well. While this is happening at a structural level, we are actually maneuvering through a cyclical downturn within that longer structural uptick. This period, yes, we were anticipating destocking will happen. I think that period has just got elongated a bit. There has been a fairly high degree of competitive intensity from China. So as we look at things from here on, the expectation is sequentially you will continue to see improvement in earnings. The base continues to remain very benign. These companies have, particularly Naveen in particular, has put in a fair degree of capex on ground. So they've spent 1,600 crores on capex in the last 2 years. So as those assets start to get sweated out, you will see the benefit play out as far as earnings growth is concerned. We are remaining very watchful because of the fact that yes, intensity remains high. It is also dependent upon how global growth will play out. But our sense is structurally chemicals as a pocket is well placed from a more medium to long term perspective. Naveen, while we've pared down weights, we continue to remain watchful. The expectation is earnings growth will start to pick up gradually from the second half, and it will continue to gain momentum in FY26 because most of the large capexes get completed in this fiscal year. So, be it the agrochem 540 crore expansion that they are doing on the agrochem intermediate project, or the AHF project, which is another 400 crore. So, all these capexes will get completed in FY25, and you will start to see the benefit of that play through in FY26. It might come on stream at an opportune time as restocking begins. So that should also help. Given the fact that capexes have happened, you not only have a drag on the operating profit to a certain extent, you also have a drag below that line because depreciation and interest comes to hit you. So our sense is as revenue picks up, you will see benefit of both operating leverage and financial leverage play out. So that will support earnings growth. A year and a half has been what has been missed out, particularly on this destocking period. So our sense is as earnings come back, you will start to see performance also start to inch up. On Sirma, which has been a second name, which has underperformed, while revenue growth has been in line with what we were anticipating, the big miss has been on margins. Now, this business is a business where margins are more determined by the product that you are selling in a particular quarter and the customer to whom you are selling the product. So the margin is a combination of both customer and product mix. While revenues have been in line with what we were anticipating, the mix has been inferior. Our sense is, and what we pick up interacting with them is, towards the second half, you will start to see that positive mix play out. We are very watchful because we've seen disappointment on earnings for now 2.5 quarters, particularly last 3 quarters. We've seen earnings disappointment there. So we've kept it under a very close watch because if you don't see an improvement on margins, that has an implication on the ROC itself. While price has corrected, so that has meant that valuations there have also moderated. So we are keeping a close watch there. The expectation there was margins will stabilize at 7.5%. This quarter we hit probably a low of 3.5%, 4%. And this is a business which has a higher asset turn. So any uptick as far as margins are concerned plays through, particularly on the ROC side. I also see a question, Manoj, on the chat box where there is a question on why Sirma and not
Yes,
Keynes and
yeah,
Dixon. So I think Dixon
correct.
was a part of the portfolio. There was a period where Dixon was also going through this pain period, where for 3 quarters they missed on their earnings expectation. Given our internal risk framework, we had to exit out of Dixon. This business is such where once your customer volume plays out, it also is a factor of their own market share and the product mix that you're getting. So our sense is Sirma probably stuck there at this point of time, where even at that period Dixon was probably stuck. Between these names, we felt that there will be more value creation here, given the potential of improvement in ROC and earnings growth. So we are keeping a close watch here. It has been a disappointment, but the expectation is, and what we pick up interacting with the management is, probably you will start to see margins improve from the second half, given their order book and given the mix which they are witnessing in the order book.
Yeah, I guess a name to highlight could be Polycab also, right? So this could be on a positive side. I was with you during a client meet, and during December, the stock was in news for a negative reason, and we maintained our conviction, and that has played out very well. Could you please share a few thoughts around that conviction around that stock?
No, so clearly these businesses are more distribution-led businesses. So there is a very strong moat as far as how these businesses have been created. While yes, there was a negative news flow, I think that still continues. We've not heard anything incrementally there, so we leave it at that. But that inquiry was for a 5-year period. So when you look at it in that context, then it was essentially in 5 years they would have had a cumulative revenue of 60,000 crore. The company still continues to say that on their part they've not received any follow through that has happened. We had a conviction, particularly given the strong moat that they had built, the opportunity that lies in the export market, and the fact that they will be a key beneficiary of how the domestic capex was also playing out. So we held on to that. We continue to still believe that cables and wires is a pocket which indirectly is a play on real estate, indirectly is a play on capex that is happening, particularly on the electrification side. And there is a large export opportunity that also sits there.
Great. The list of new addition stock is relatively very huge. But yes, the recent stock addition, particularly on the Adani side. So we have added Adani ports, right? And especially on that time wherein the Adani is also in nude. Could you please take us through the new addition Adani port and SEZ?
Yeah, so I think that is more of a play on how we believe manufacturing will play out. So if India becomes a manufacturing hub, logistics is a key component of that. They have a very strong play as far as their port assets are concerned. So those assets which have been built on a strategically built locations. As export picks up, you will see an improvement in EXIM volume. They are also investing on logistics internally as well. So that will also be an earnings driver. So the expectation is that Adani will be an indirect beneficiary of manufacturing. We expect volume growth to remain strong there. These businesses, yes, are asset heavy, but if optimally utilized and sweated out, they are reasonable ROC businesses. So the idea while entering to Adani port was they clearly have good assets, particularly now both on the western coast and on the eastern coast. So that means there is a strong play on both ends. We are actually seeing a fair degree of uptick on capex, particularly now on the eastern side of the country. Odisha has become a fair degree of hub as far as entire steel capacity and higher capex intensity businesses which are more linked to minerals is concerned. So even the eastern periphery is actually seeing a volume uptick, and they've over a period of time through inorganic route got reasonable presence now both on the eastern and the western side. So that is more to do with how we see manufacturing play out and players who will benefit within that ecosystem.
Also, Chetan, if you could also cover the KPIT Tech. We were not present in IT space and we have added IT with a mid cap. Could you please take us through that stock as well?
So, like you rightly mentioned, I think that space we can probably bifurcate into two segments. One is the large cap IT players, which are still continuing to witness pressure because there is a book which is running down, as the new book adds to growth. There are cutbacks and scale back on the client side. The contracts have moved more from growth towards cost optimization. So that means those contracts typically have lesser margins. So we are seeing that play out on the large cap side. Even on the mid cap side, we are more focused on areas and sectors where there is still higher spending by clients. So ER&D clearly stands out. That is a space and pocket where there is a structural tailwind, primarily driven by two factors. One is there is a lower degree of outsourcing that happens on ER&D side. So globally, as that share picks up, you see higher ER&D spends happen there. The second bit is spending still continues there. Now, within that pocket, there are various subsectors. I think a sector in which we believe will continue to see spending happen is the automotive space. There we are seeing a sharp transition that happens from ICE to EV. While yes, there is some degree of negative news flow as far as EV adoption is concerned, our sense is this is a cycle itself. So whenever the transition happens, you see a phase where this push and pull happens between technology. But clearly the automotive companies and the global OEMs are continuing to push towards the EV side. So there is a fair degree of visibility as far as those spends are concerned, and KPIT is well poised there with a large exposure on the automotive side. So as long as those spends continue, and these spends typically on the automotive side are a longer cycle spends, they are spends which are for 3 to 4 year period. So our sense is given their advantage on the automotive side, this is a company that will continue to benefit from the higher ER&D spend. Within higher ER&D spend, particularly a higher spend on the automotive side. So that is why we've taken some bit of exposure by way of KPIT. I think during this period, we had added Cyient as well in the portfolio. That was more focused towards the aerospace side, but we've actually been disappointed by the earnings delivery that has happened there. So remaining cognizant of how we expect things to shape up there, near term remains weak. We've actually even exited from Cyient and replaced that with KPIT.
Fair enough, Chetan. I'm taking a participant question, which is basically curious to know that why are we not participating in new gen technology company? Any view on that? Maybe an AI or something kind.
So if you look at how that ecosystem is playing out, if the question is more on the new gen side, so there are two or three things that are happening. One is if you look at the entire AI space, I think most of the AI innovators are sitting in the developed world. You will probably have implementation that happens here. That implementation will typically happen through most of these larger IT names or the mid-cap IT names, which eventually deliver at the client end. The second bit is whatever AI gets delivered by the cloud itself, be it Azure or be it AWS, that happens directly on cloud, but that will also require customization. So our sense is, yes, AI has a big pocket, but when it comes to implementation, you will actually see implementation happen through most of these integrators that are there. And they too are pushing AI from that end. While AI is a very generic term, our sense today is that companies are also trying to figure out what works best with them. There is a big debate out there on whether AI alone is good, human alone is good, or a combination of AI and human alone is good. At the end of the day, these are productivity enhancing tools. These are tools which will probably open up new opportunities as well, even on the customer end, and from companies' perspective, help to reduce cost as productivity. So all those spends will eventually get captured even by the integrators who are here. But most of the guys who are on the cutting edge, be it the LLM models, are actually based on the developed world. So we are trying to participate where we believe that there will be a fair degree of AI help that comes through. So even when you look at companies like KPIT, for example, or LTTS, for example, all companies are structurally looking at their services to say that where can we build up AI capabilities which eventually help my client. So that is how it will play out. Coming to more new gen platform businesses, I think some of them have started now to do well after a period where they've scaled back or cut back, particularly on the higher spends that they were making. On that pocket, we still are monitoring the situation more closely. At a point of time, we were not very comfortable given how unit economics could play out. Today, after we seeing a fair degree of volatility there, we are actually seeing some of these businesses turn around. So we are keeping a close tab there, while most of these businesses still continue to struggle from their peak to now. So we are monitoring this space closely to see where we want to participate, and when if and when we feel that we can participate in a particular pocket, valuations look reasonable to us, we'll probably go there and participate.
Uh, Thank you, Chetan. The question is around last 2 years, particularly defense, railways, and power, right? Though we have participated in some names, we might look at other names also. But what is your view and how do you see these three sectors?
No, so clearly, power, I think, is a pocket which we believe there has been a switch. I think 3-4 years back, there was talk about just 30,000 megawatt getting added over a period of 5 years. That has now been scaled to 88,000 megawatt getting added over the period of next 5 years. So that clearly means there is a higher power requirement. Capex did not keep pace with that in this period of time. We have taken, like you rightly said, some degree of exposure there, be it by way of BHALE, which is a beneficiary, REC, which is an indirect beneficiary of the entire power ecosystem, how that plays out. So we've actually taken exposures in those pockets and pockets where we believe that there will be tailwind. Businesses meet our criteria. So we've added exposure there. So if I were to combine the exposure of an REC, a COIL, and a BHALE, we have a fairly 11-12% kind of exposure that is there in that particular pocket. We've also recently added some exposure in that particular pocket by way of Adani Energy. So that is also some weight that we've added there, which is a very recent addition. That clearly is to do with the entire T&D opportunity and the smart meter opportunity that we expect will play out there. So we have now sufficient allocation to that particular pocket. So 12-13% weight in our assessment is a fair enough weight to one particular sector.
Yeah, Chetan, there is an interesting question which is basically about high growth, high conviction portfolio versus the momentum based, which is very prevalent in the current market. How do you take that question and how do you see it going forward?
No, so very clearly, we firmly believe that high growth, high quality creates value over a longer period of time, helps to go through this period of volatility. Having said that, I think rightly pointed out, there are certain pockets where there is momentum. The way, like I was mentioning, we've decided to tackle this is we'll not dilute on the quality aspect to it. We will probably dilute to a certain extent on how we want to play valuation and earnings combination. That is why you're also seeing a higher degree of churn, where we are actually trying to capture businesses where we believe that there will be an uptick or the momentum on earnings growth in the near term is higher. Might not be true from a more longer term perspective. It might still be lower than what we expect our businesses to do. But if it's not adequately captured in valuation, we will participate that. So consequence of that, yes, is higher churn. But the way we've decided to tackle this is to look at businesses where we believe that they meet our criteria on quality. We see an uptick in earnings happen in the more near term perspective, which is not adequately priced. We will go out there and participate in those businesses. So that will mean that there will be frequent entries and exits that has happened, which has not happened over a long period of time. I think all our investors here would know that typically we've had a lower churn. Compared to that, the churn is higher because this is how we've thought that we will deal with the current situation, not compromising on the base philosophy, but trying to optimize within the frame.
Yeah, so I think Chetan, the questions was on the same line that is there any mandate to the fund management team on the holding period or else while as we have made quite a few changes considering the tax impact also on the client is what the question is around. So maybe very portfolio centric
I think Manoj, your voice got cut there. If you could repeat the question.
would request client to reach to the RM, but still, if you could want to touch upon.
I couldn't
Acha.
get your full
Do you want
question
me to
because
repeat the
your voice
question,
cracked in
Chetan?
between. Yeah.
Okay. So basically, the question is around the same, the transactions which you were referring to, that we have made certain changes. So is there any mandate to a fund manager or an investment team? And do we consider the transaction cost or tax implication is what the question. So one is I would request customer or a partner to reach out to the relationship manager for the better answer. But if you could touch upon from your side.
So yes, we are cognizant of the fact that higher churn will mean higher number of transactions. It will mean an implication on the taxation side as well. But the idea clearly is that if we have an opportunity where we believe we can get higher return in the near term, we would focus there and not be more focused on how that plays out as far as taxation is concerned. But we are very much cognizant of the fact that churn will in turn mean higher transactions. It will have a tax implication as well. So a classic case probably is, say, a Honeywell, where we bought and exited in a matter of 1 month, but we got 25% return in a matter of a month. So we essentially, what we expected to play out over a course of a year, given how the markets were, we could get that in a month's period. We decided to go ahead and make those changes as well. So I think, yes, we are cognizant, but we are also trying to do what we need to do to optimize the return.
Yeah, Chetan, there is a question from Mr. Sharma. Basically, he's referring to the government focus on affordable housing space. And are we looking at this opportunity? And are we probably planning to add some stocks around that?
So we continue to monitor that space in particular. So I think there are two ways to play that. One clearly is to go ahead with the real estate company who's executing the project on the affordable housing side. Given our understanding, what we've understood is if timelines in those projects are not met in a stringent manner for external reasons, IRRs for those projects end up getting under question and they suffer. So we are actually trying to see, can we play this opportunity more from a lending side and from a lending perspective. So there are names and businesses which are there in a universe set which we continue to evaluate, who have a higher degree of exposure on affordable. And if we believe that there is a name where we are comfortable with valuation, we are comfortable with the growth that they can deliver, we'll probably at that opportune time go ahead and participate there. What we've done so far on our financial exposure is, you would have noticed, we've pared down our banking exposure in the portfolio. That is clearly to do with the fact that we believe earnings will be muted in the near term in that particular pocket. While NBFCs will see a positive playthrough that will happen whenever interest costs go down, because for them the liability will get repriced faster, and that to a certain extent will support spreads as well. So we actually have a higher allocation to NBFCs. Similarly, we are exploring this particular pocket as well to see that can we find enough names who have direct affordable housing exposure and where we would be comfortable participating. So as of now, we have a higher exposure on NBFC, some small exposure on capital market by way of CDSL that is there in the portfolio, but it clearly is there within our radar.
Yeah, citing the same, I guess we had a decent exposure to banking space wherein we have made a complete exit. So what is your view on banking as a sector going forward? They are seeing a challenge towards deposits, raising deposits also. So how are you reading banking sector?
So like you rightly mentioned, I think there are two things. One clearly is we believe there will be NIM compression. We've seen probably a peak of NIM compression in Q1 that might still follow through in Q2, but NIMs will be compressed. So that will mean that NII growth will trail loan growth. The second aspect was more on the credit cost side. Credit cost also was significantly lower. Our sense was that will start to get normalized, and we are starting to see that play out, that credit cost is getting normalized. To top this all up, I think there has been an external play, like you pointed out, on deposits. So there is a clear challenge on deposits. So that will mean that probably intensity to garner deposits will go up. That might mean that the pain might be there for a longer period of time as far as NIMs are concerned. If I were to zoom out a bit more, then whenever interest cut happens, this will probably be the first time when a large part of the book for most of the banks is linked to repo. So we'll actually see the negative side play out. So probably till middle of last year or even third quarter of last year, we saw a positive play out, because when interest rates moved up and these loans were linked to repo, you actually saw NIMs expand, and which in turn meant ROAs and ROEs expanded much faster than anticipated. Whenever the cycle turns on the reverse, you will actually see the same factor dragging the NIM further down. So that is why we felt that yes, there is some degree of pain from a near-term perspective. So we kept our exposures in NBFC, we reduced exposure in banking, we also increased exposure in other segments where we believe we needed to increase it.
Yeah, friends, if you have more questions, we would request you to type in. Yeah, the performance of our fund was benchmarked against the broader index Nifty. So the I think participant has requested for the comparison. Maybe I would request you to get in touch with your RM and he would take you through that part. Yeah, I've got a question basically wherein again also on the performance itself, that relatively they are not happy, and when are we looking at improvement? So maybe yes, there is an uptick in last 2 quarters, but what is the way forward is what the question is around.
So as mentioned very clearly, our sense is that earnings momentum will start in second half. So our expectation is you will start to see that getting factored in somewhere towards the end of second quarter or early part of third quarter, as more information flows through, particularly how volume growth will happen in the festive and post-festive period. So that is, from a timeline perspective, we would be monitoring that timeline very closely. The second aspect is organically the changes that we've made to the portfolio, that itself should start to add 150 basis point organically to the performance. Yes, we acknowledge there is a gap, a large one, compared to the benchmark and our portfolios. The idea clearly is to catch up performance, remaining true to our investment philosophy and not take higher risks to catch up performance. As we expect earnings momentum to pick up only towards the second half of this fiscal, our sense is you will see performance also follow through from that perspective. So we are also monitoring closely on how things shape up as we approach the end of the monsoon period, as the festive period starts to kick in. So our sense is we will start to see, once the confidence on earnings delivery comes in, given what is happening on the environment, you will start to see that catch up happen. The second bit is also the fact that both capex spend and export is also more skewed towards second half, because monsoon typically is a period where project execution gets slowed down. So to that extent, Q3, Q4 is stronger as far as execution is concerned. Exports also clearly is pointing towards a recovery in second half. So the expectation is you will start to see that uptick happen. The second bit, which is a more play on re-rating, that is macro dependent. So our sense is whenever you see a downward revision on interest rates happen and when that cycle starts, you'll probably see that also contributing, but we don't want to factor that into it.
Yeah, thank you, Chetan. I must add here that the kind of 2 notes which we have shared with our partners and clients, they are very happy with the way we are giving that conviction, and we hope that the performance, which is not great at this point in time, would be on our side. Yeah, I thank you. I believe we have covered all the questions. We do not have any further questions. Chetan, I really thank you for your time. And the way you have taken us to the portfolio and market outlook, it was quite helpful.
Sure. So thank you, Manoj. Thank you, everyone, for joining us this evening for this call. We are clearly focused on getting the performance back. We are making the necessary changes that we need to make. We are being more agile, and we are keeping still the more medium to long term into perspective as we are making these changes. So we expect that improvement should start come through, like Manoj mentioned. There are early signs, but we will still very closely monitor the earnings growth in second half. And if that follows through in line with what we are anticipating, then we should actually see a positive catch-up that happens. So thanks once again, everyone, for joining us this evening. Have a great weekend and speak to everyone soon. Thank you so much for that. Thank you, Manu.
Thank you. Thank you, ladies and gentlemen. This concludes the call. Thank you for joining us.